Hello everyone and welcome back to the RPAG Scoop. If you couldn't tell from our intro video, it is our first birthday. So it is the 1-year anniversary of us recording the RPAG Scoop for you. And we've come a very long way. So to celebrate the 1-year anniversary, we did give the RPAG Scoop a little makeover, if you can tell. We've got a fresh lineup today, including the top 10 resources at RPAG with our Chief Relations Officer, a look at how retirement planning rules could be affected by the upcoming election, an exclusive interview from PGIM about their Core Plus CIT strategy, and educational insights from Alliance Bernstein. So to kick off our anniversary edition, we do have Veronica Lee, our Chief Relations Officer, that wanted to give you a fun and informative segment about the top 10 resources at RPAG.
Hello, beloved RPAG members. My name is Veronica Lee, and I'm Chief Relations Officer, and I'm excited to be in front of you today doing the Scoop. It's an exciting time here at RPAG, and it's the anniversary of the Scoop. So happy anniversary, Scoop. We're so happy you're with us. Today, I'm excited to talk about resources that we here at RPAG offer to all of you that are at your fingertips that you may not necessarily know about. There's so much that we offer. I get it. It's a lot. So I'm today going to talk about 10 resources that if you don't know about, now you do. So starting with number 1, we have a vast support system for all of you. A toll-free number, an email. You can call us, email us during these hours, and there's a team of professionals that will get back to you most of the time, same day. Any question under the sun, whether it's how to navigate something on our portal or something, a sophisticated investment question, anything with regards to your practice that you can think of, we're going to give a shot at answering for you, including ERISA questions. So if you don't know, you can send case-specific scenarios to us at RPAG. We have a team of ERISA resources that will analyze it, research it, and then give you a write-up that you can rely on at a later date. So if you have those challenging ERISA situations and wish you had someone to talk to about them that has legal background, ERISA background, please think of us. We love helping you with that. Time. So anytime during those times, you will most probably get a same day answer. And then but feel free to email us even during the weekend, and we will get back to you that next business day. So think of us when you're looking for support. Support emails, support phone calls at RPAG. Second resource that I hope you know about is the RPAG monthly newsletters and participant memos. So these are written for the audience of plan sponsors on a monthly basis. And then it's hot topics that will be relevant to them. This is fresh content that we provide to you every single month. And in addition to that plan sponsor piece, we also include a participant memo. So something relevant, something fun for them as well. Again, every single month, it's brand new content. It's FINRA reviewed too. So easier to get through your own compliance departments. We have a FINRA letter associated with them as well. You're welcome to brand it however you like. You're welcome to distribute it however you like. We provide it as a resource for you. Again, every single month, you have access to that. It's in our resource center. The next item I'd like to talk about is RPAG University and our Milestones program. So when you have a new team member join your firm, or perhaps you are a newer firm to RPAG, and you're wondering, how can I absorb everything that there is to know about RPAG? How can I learn it? Especially for new team members, right? It's it's time consuming to train new members, new people in your firm. Well, how great is it that you don't need to train them yourself necessarily, or maybe perhaps it lessens the amount of time you have to spend with them if you direct those new team members to RPAG University. So it's a learning management system built right into the RPAG portal, and it gives you a series of short videos on the most commonly done tasks and generated reports in our system. With that, there is a milestones program where if you're more of an interactive learner, you can request a milestones training, and that's where we will pair you with one of our advisor service associates here for live virtual training. Next, I'll tell you about our resources for RFP advisor projects. So you advisors out there, as you know, more and more plan sponsors are engaging in a formal process to choose an advisor. And that's great for you when you're looking for new business, because with RPAG supporting you, every question that they ask, you're going to have a wonderful answer to. So we at RPAG created a list of commonly asked questions during this process and crafted answers to them. So that's our RFP for advisor questionnaire, and it does come with answers too. Now, this is a resource that is available to our premium subscribers, along with our additional marketing resources. But if you'd like to see a sample of that, of a question and an answer, we're happy to provide that to you. Along with that premium service, included is yet another resource that I hope you know about, and that's our hosted webinars. We all know how important prospecting is, marketing is, but we also know how much work goes into hosting events, even virtual ones. So we at RPAG do that for you, where 4 times a year, we will host webinars intended for prospective clients, but you're welcome to invite your current clients as well. We choose the dates, we choose the topic, we provide the presenters, and we get the invitations, compliance, and FINRA reviewed. And all you need to do is push out that invitation to those you are marketing to. And again, like I said, you're welcome to invite your current clients as well. It's a wonderful tool for retention. Once the webinar takes place, the live webinar takes place, then you can send us a list of who you invited, and we can let you know if they attended. And whether they did or didn't, it's a wonderful touch point for you to reach out to these prospective clients. In addition to those 4 webinars, hosting them for you, the presentations that are used are available to you as well. So if you wanted at a different date to present that information yourself, you are more than welcome to. So a really nice service if you're looking for enhancing your marketing efforts. This service specifically is part of our premium marketing package. Another resource I'm wondering if you know about is that we at RPAG maintain dozens of contacts with all of the major record keepers and money managers in our industry. As you can imagine, these people are eager to get to know you. So when you're looking for a resource with a money manager or a record keeper, you need an elevated contact, because perhaps you're working on a plan and something isn't going right, as sometimes that happens. And sometimes we just don't feel heard and just need a little bit more support at a higher level. Think of us at RPAG. You can call into support, email into support. You can ask for hey, do you have a higher level contact at T. Rowe Price, for example? Do you know somebody at Capital Group American Funds that can help me? And we have people that are going to care about whatever it is that you need. As you can see, most of my resources and ideas are to support you. That's all we do around here is think about ways to support you to help you succeed. All right, what's next? Yes, our stable value analyzer. So for those of you that meet with clients and plan sponsors, you're reviewing investments periodically, as is important to do. And the RPAG scorecard system is certainly one that's easy to understand. So if a fund is assessed a numerical ranking from 0 to 10, you know that 10s are good, you know that 0s and 1s might not be so great. But what do you do with stable value funds, cash accounts that are in retirement plans and that are not assessed a score? There's still a fiduciary obligation to review those investments, as we all know. And that's why we at RPAG created the Stable Value Analyzer. So give that a try. It's one of the tools in our system, and it helps you put together a nice analysis that reviews different aspects of stable value funds so that you still have something to present and that can be documented by the plan sponsor as their due diligence on a fund that isn't going to get a score. It just doesn't make sense to give a stable value fund a numerical ranking, but it does make perfect sense to provide some kind of analysis instead, and that's what the Stable Value Analyzer, so named, does. So don't forget about your cash accounts. Well, I can't name our most valuable resources without talking about our CITs, our collective investment trusts. Now, I know that most of you know what I'm talking about, but in case there are a few of you that don't, we at RPAG have approached premier money managers out there in the marketplace. We look at their best funds and we ask them to create versions of that with us and to discount them greatly for your plan sponsors. And that's something that's only available to you as RPAG members, exclusive to you. So previously, or I should say typically, these types of low-cost investments are only available in the mega plan market. But now any plan that you advise to can access that type of pricing. It really is incredible. And that's just because of the collective strength of all of you as our PAG members. So you want to take advantage of that. And similarly, enough to mention it separately, is our ability to provide you with target date fund comparisons. Do we have the target date analyzer where you can create them yourself? Of course we do. However, do you know that you can request us at RPAG and our staff members to create target date fund comparisons for you? That means you don't have to do the work yourself. Your staff members don't have to do the work themselves. All you do is tell us what funds, what target date funds you want us to compare, and we're going to turn those comparisons around for you in just a matter of days. So please take advantage of that. That's incredible. I know when I was managing my biggest block, having that type of help to have other people do the analysis for me to review, was a resource that was incredibly valuable. So that's 9. My last one, number 10, is to remind you that we at RPAG hold a national conference every September at the beautiful, the gorgeous, the resort like none other, the Ritz-Carlton Laguna Niguel, located here in Southern California. Beachfront property. It's an amazing 3-day event where you'll get to sit in on valuable sessions that cover every topic under the sun needed for you to feel re-energized in your practice, from sales to marketing to investments, ERISA. You'll get to connect with these wonderful record keeper partners and money manager partners. They'll all be there too. As a reminder, we at RPAG cover the cost of the Ritz-Carlton room. for the 2 days that you're with us, excuse me, for the 2 nights and 3 days that you're with us. So we cover 1 room per member firm. We are going to treat you to every meal during our conference and every social event as well. We welcome you to bring a spouse or a loved one with you. They won't unfortunately be able to attend our sessions, but they can enjoy the beautiful Ritz-Carlton grounds while you are engaging with your peers and with us during our sessions. And I'll say that this year is incredibly extra special because we are celebrating at RPAG our 20th anniversary. The theme is Jubilee, and truly we are looking forward to a celebration of your success. We value you. If you take away nothing other than that for the few minutes that I've spoken today, I hope you remember that we value you. We're here to support you. And don't hesitate to let us know how we can make you as successful as you want to be.
Thank you so much, Veronica, for that great overview of our top resources that our members can use. Next, we have an insightful segment on the potential impact of the upcoming election on retirement policies. Mike Berry from the Retirement Learning Center will break down what both sides of the aisle are proposing and how it could affect our industry. Let's hear what Mike has to say.
Hi, everybody. This is Mike Berry. I am with RLC. I've been in this area since 1976 in law firms and some consulting firms, and then in writing about and analyzing regulatory developments in this area for 25 years. So what I want to talk about today is, in effect, partisan issues, that is non-bipartisan issues that are in play in the 2024 election. Just to be clear about this, there's a set of issues that are a little bit more small ball, where there's bipartisan support and might become part of Secure 3.0. That's not what I'm going to talk about. I'm going to talk about things where there's no bipartisan support, and therefore these issues are likely only to move if Democrats or Republicans run the table. They win the White House and they win both houses of Congress. In addition, and there's an exception to this that I'll mention in just a second, but in addition, generally, to get anything through the Senate, you'll need 60 votes to shut off debate. There is an exception basically once a year for budget and tax legislation. And a lot of these issues do wind up being tax issues or in the tax code. So it may be possible to do some of this stuff with only a mere majority in the Senate. Let's also note that, and this would be if the Republicans got in, there is a possibility of repeal of regulations through the Congressional Review Act. This has got to be done within 60 legislative days of that regulation becoming final. And that explains why, for instance, the Department of Labor rushed through the advice fiduciary rule to make sure that if Republicans got control of Congress next year, they wouldn't be able to use the Congressional Review Act to repeal that. Let's finally also note that in the agencies, and this is mainly for Republicans since Democrats have been in control of the White House and the administration, if the new administration wants to reverse the rule, they can just do it at the agency, although in many ways that may be easier said than done, as we'll talk about. All right, let's start with the Democrats. So Congressman Neal, who, when the Democrats controlled the House of Representatives, was chairman of the Ways and Means Committee, has had for a very long time a project of creating a requirement that all employers, and there's an exception for very small employers, have either an auto IRA where you default someone into saving through an IRA and that person has to elect out of saving, or a plan of some sort that will cover those employees. His proposal right now, which he's introduced in this Congress, requires the default to start at 6% to increase to 10%. There's an exception for current plans for employers, very small employers with no more than 10 employees, and for the first 2 years of a new business. That will be a priority if the Democrats get control of both Congress and the White House. Next, there's a project. We saw this sort of emerging, but we saw this in the Build Back Better bill from 3 or 4 years ago. It was taken out of that bill, and it was controversial. But there's a proposal to cap retirement accounts and then to close backdoor IRAs. So the cap on retirement accounts, let's be clear here, this is for account-based plans. They basically add up individuals' accounts in defined contribution plans, 403Bs, 457Bs. They don't count defined benefit plan benefits in this analysis. If that person has more than $10 million in a year in account-based plans, they have to distribute at least half of that. So the goal here is basically to put a $10 million lid on account-based tax-favored retirement savings. There are also some additional requirements if the individual has more than $20 million. The other proposal that Democrats have that's targeting our area is backdoor Roths, basically, but the rollovers into Roth IRAs, Roth conversions, and they will strictly limit that basically to Roth money. And so this ability to convert after-tax contributions into Roth contributions through a backdoor IRAs would go away. All right, so those are the Democrat proposals that focus on our area. I do want to note one other issue that's a big issue for Democrats that's broader, which is Democrats want to increase tax rates on high earners, basically people making under $450,000. And I've noted them here. They want to increase the corporate tax to 28%, the highest marginal personal income tax rate to 39.6%, and the Medicare tax on net investment income from 3.8% to 5%. And these tax increases will, in effect, make the tax savings juice that qualified plans, IRAs provide more valuable. And so that will, at the margin, increase the incentive to form plans, to put more money into plans. All right, so that's it for the Democrats. Let's talk about Republicans now. I see two issues that Republicans are particularly focused on. One is they want to back off of the Department of Labor's recent fiduciary advice rule. There's actually bipartisan support. It's very narrow bipartisan support. Senator Manchin in the Senate has signed on to a bill right now under the Congressional Review Act to, in effect, repeal that regulation. And there's probably more than one Democrat that is leaning towards supporting this action. The problem is that with the White House in control of the Democrats, even if they could get this through Congress, and remember, for this legislation, you just need a mere majority in the Senate. Even if they could get this through Congress, the president would veto it, and at that point, you need 2/3 of the House and the Senate to override that veto. That strikes me as very unlikely. However, and for that rule, the window for that kind of congressional action, where you only need 50 votes in the Senate, runs out after 60 legislative days. So while there you might not have to completely run the table to get rid of this. That's just a scenario that I don't see. But on the other hand, since this is just a rule, it's possible that the administration, if Trump won in November, that he could somehow make the Department of Labor change its position on this rule. And in fact, when he came in 2017, he had an executive order that said, look, go back and take a look at this rule, and I want it to be changed in these regards. None of that ever happened. I think that the question here is in part going to be the ability of a Trump administration to get control of the Department of Labor, and I'm not sure that will happen. I mean, the DOL is very committed to this rule. I don't want to say in a bipartisan way, but it's not in a partisan way. I mean, the people in that agency believe in this rule, and how you move an agency off of that, it's easier said than done. Let's also note that there's also litigation challenging this rule, and in 2018, that was in fact the trigger that vacated the 2016 rule that the Obama administration had come out with. And there's a greater than minimal possibility that litigation challenging this rule will be successful. We don't know. We've got one lawsuit filed so far. There's going to be at least one more, and we'll see if nothing happens in Congress, nothing happens in the agency, something happens in the courts. All right, the other issue, and I think this is an issue that a Trump administration would pay attention to, is the ESG rule. And here, I think, so the motive here, it seems to me, for Republicans is probably mostly around the environmental, and that I think as a sort of meta policy goal, increasing US energy production will be a priority for a new administration. So they will want to try and do something about this. There are Republicans in Congress now that have formed a working group looking at this issue. I don't know, though, that they're going to solve this issue in our world, in the ERISA world. The first place it looks like they want to look at is the SEC proxy rules on these issues, and see if they can move those in a way that will make it easier for, in effect, management to get its policy goals through annual meetings in a way that can't be challenged by like a outside director challenge. It's possible that they could revise the ESG regulation. Every change of administrations has resulted in a change of ESG guidance from the Department of Labor. There are two issues in ESG. There's ESG funds and putting ESG funds in plans. And I think this is particularly an issue in defined contribution plans, in 401k plans. I don't think that issue is going to go anywhere, and a challenge on that issue is going to go anywhere. And you can see that in the litigation that we have against American Airlines right now, where they pivoted halfway through, and instead of attacking what kind of funds you put in this plan, they attacked the proxy voting of the managers of S&P 500 funds. And that I think it will be more the second issue, which is the proxy voting rules, that will get attention here at the Department of Labor if they try to do something at the Department of Labor. Let's note that there's litigation right now by the 26 states against the ESG rule, and in that litigation, they're attacking that rule as it regards the selection of funds, but also as it describes how proxy voting works. it's hard to say where that litigation is going. So I want to end this discussion of this is that I think it will be a priority if Republicans get effective power. That is, either they run the table or at least they get control of the White House, that they will want to do something. I think that something is going to focus on proxy voting. That proxy voting change may wind up making changes in our area about how you think about proxy voting. That I just want to note as we wind up here that, as I said, these are the non-bipartisan issues that could come up. That if we have a divided government, if we have a Republican House and a Democrat Senate like we have now, and a Republican White House, I think we'll be back where we are now. That is a long-term project at an opportune moment to get something probably called Secure 3.0 through Congress that will deal. It'll deal with the 403B issue and collective trusts in 403Bs. What else it will deal with is unclear, but they're sure to tweak some stuff around coverage. But I don't think they'll be able to touch any of those issues that I just walked through here. That's it. Thank you very much, and hope to see you again.
Thank you so much, Mike, for that valuable insight about how the future election could eventually impact, retirement policies. Now let's shift gears a little bit over into investments. Our Chief Investment Officer, Jeff Elvander, recently interviewed Mike Collins, the Senior Portfolio Manager for PGIM. They discussed PGIM's impressive Core Plus strategy for their CIT, and why did we decide to use it? Find out right now.
Okay, welcome to our RPAG Scoop. And today we are going to have a conversation with Mike Collins from PGIM on their total return strategy, who we use in the Core Plus space. They are the managers for our Core Plus RPAG exclusive CIT. Mike's been around on the team for 15 years. He's currently the managing director, executive portfolio manager on the team for PGIM. So Mike, welcome to our call today, and to provide our advisors with some insight on the strategy and what you guys are doing. And first off, congratulations on the success that you guys have had. Certainly one of the reasons we've enlisted you folks to manage this strategy, because of the tremendous success that you've had. And I believe it's over the last 5 and 10 years annualized, well over 50 basis points of excess return on an annualized basis that investors have been experiencing. And this is a great time to have this call to talk about fixed income. There's a lot of things going on in the fixed income markets. I know one of the larger funds right now is losing its last of its 3 lieutenants, and maybe some issues with some other managers out there. And but before we get into positioning and today, Mike, maybe I just wanted to turn it over to you and back to, again, the performance and success, how you guys construct the portfolio, what you guys have done and what's been successful. If you can maybe start with there for our advisors.
Yeah, well, thank you, Jeff, and thank you so much for having us and having me on your scoop this month. And yeah, so the PGIM total return strategy, as you know, is a core plus oriented strategy, but really our focus is generating really diverse sets of alpha over many cycles, right? We have probably the biggest research team in the public fixed income markets globally. We have about 140 fundamental credit analysts, another 20 or so macroeconomists and strategists, and another 70 or so risk analysts and risk managers. So we are throwing a lot of resources at building optimal portfolios by sourcing the best opportunities across the global public fixed income markets. And a big part of my job and the job of the senior portfolio management team is to steer the portfolio, manage the duration actively to some extent, manage the credit risk actively, and then within that credit risk budget to allocate to the best sectors of the global public fixed income markets. And then the real punchline is the bottom-up security selection, right? And these, over 100 analysts and portfolio managers each specialize in a specific industry, in specific asset classes. So we're really able to generate a lot of bottom-up relative value, best ideas. And again, my job is really just get all of those best ideas into this portfolio. And we really want this total return strategy to be one-stop shopping for your clients, right? I mean, this is a high quality, mostly US, intermediate duration, bond portfolio that's going to behave like the aggregate bond index, but with, as you said, that alpha. And actually, our alpha target is actually in excess of 100 basis points annualized. And I think over long terms, we've achieved that. So really compelling story, especially today, as you mentioned, in the really high interest rate environment.
To cover all of those sectors and, investment grade, securitized mortgages, just the whole fixed income universe is huge. Just if you could comment on the size of the team and the analysts and give our advisors a perspective. Well,
everybody on the team, we have about 400 investment professionals in our shop, and for the most part, the bulk of them, Jeff, have some input into this portfolio. Right, this is a big, broad, multi-sector portfolio that can actually draw on the best ideas from every one of those asset classes. So we actually have a dedicated government team. We have a dedicated agency mortgage-backed securities team. We have an investment grade corporate, a high yield, a leverage loan, an emerging market. We have structured products teams looking at things like CLOs and commercial mortgage-backed securities and other asset backs. So we're pulling on all of the different analytical firepower. So all 140 or so analysts and all 120 or so portfolio managers can really have input into the bottom-up security selection. The senior portfolio management team, which is, there's about 5 or 10 of us who are kind of steering the portfolios every day, are really looking at the whole, positioning, the overall risk profile, the interest rate risk, the credit risk, and making sure those best ideas are being allocated in the right way at the right time into this portfolio.
And, we have you in the Core Plus space. So with the plus being, right, all those, sort of sectors outside of maybe your traditional fixed income index, right, which is the ag. But that's a great way to add value. I mean, you alluded to, over the long term, you're close to 100 basis points in terms of excess return above the aggregate bond index. Maybe if you could just speak to, the plus, what you guys do on the plus side of the equation to add value. And also, I think it's a little riskier too, how you manage the risk there as well.
Yeah, I mean, we do have a internally developed, fully proprietary risk management system that we've built over the decades. And those 70 or so risk professionals, that's what they do. They build it, they monitor it, they design it, they look at the risks in all the portfolios. And it's really set up, Jeff, to make sure that we don't have, don't put too many eggs in one basket. We don't have too much interest rate risk. We don't have too much credit risk. So we have a budget for each of these risks, that we don't have too much risk to any asset class, any industry, and any specific issuer for that matter. So it really ensures that we have a really diversified, set of alpha sources. So that's the punchline on the risk. But you're absolutely right. When you add high yield or even overweight investment grade corporates relative to that aggregate bond index, which, as you all know, is a very high quality, AA rated, government debt centric bond index. So anytime you sell a treasury or underweight a treasury in that index and add anything with credit risk, you're adding risk. And we measure that risk in basis points of tracking error or relative volatility on every single trade we do, before the trade and after the trade. And then we have a model that sums them all up. So we're really careful on making sure that we don't get over our skis in any one area. Now, in high yield, for example, the portfolio typically has between, let's say, 5 and 20% in high yield, depending on the opportunity set there. Right now, we happen to be at the very low end of that range, just because credit spreads, as you all know, are relatively tight. Growth has been robust, but is probably poised to slow. These higher levels of interest rates, I think, are going to bite a little bit and cause some mild disruptions in the credit market. So we're actually playing a little defense right now. But the good news is it gives us the dry powder. We actually have a lot of excess risk budget, if you will, to utilize if things get worse. So we're actually waiting for opportunities to add, more credit risk and even add some high yield and maybe emerging market debt and other things. But right now we're in a very high quality defensive credit profile.
Got it. Yeah, and that's maybe a good leeway into, right, sort of positioning in the future and what our advisors and investors can expect. Certainly, there's been with rates, a lot of volatility. We've seen a lot of, negative performance in fixed income, at least for the ag. But where we sit right now with rates, which is interesting, I think, we were looking at maybe where the markets were expecting 5 or 6 rate cuts at the end of last year. Now, I've heard maybe one at the end of this year, right? But speak to the positioning in general, and you've already alluded to it for a little bit, and what investors can expect out of this strategy maybe over the coming years amid this rate environment that we're in right now, which is, I think, a little unique.
Yep. So I'll start with the duration profile. So the duration of that aggregate bond index is about 6 years. And we were a little bit short that, as you said, when all those rate cuts were priced into the market, we thought the markets had overshot and were really too aggressively front running the Fed and pricing too many cuts in the near term, effectively pricing in too high of a probability of a recession. And we didn't see it. Again, from the bottom up, the companies we're looking at are actually in really good shape, generally speaking. The private sector has done really well throughout this whole transition from COVID to inflation to the higher interest rate regime. So we faded that and we were a little short duration. Now that the rates have backed up, and as you said, are hardly pricing in any rate cuts in the next 6-12 months, and actually very few even in the years going forward. I mean, the Fed funds rate that's priced in is 4% for 10 years. So even over a 10-year period, there are only 5 or 5.5 cuts priced in almost forever, right? So that, I think, is an overshoot on the other side. So we've covered the underweight and duration and actually looking to get long. I mean, we would probably add a little duration. Again, the way we manage the portfolio, we're always going to be within a year of duration of that benchmark. So if we love rates, we're going to go up to a 6.5 or 7 duration, right? It'll never be an 8, 9, or 10. And if we don't like them, we'll be at a 5 or 5.5. So always within a year. And that's part of our risk management style. So we are looking for opportunities, looking for signs that the economy is going to slow or that inflation is going to come back down or the labor market's going to weaken, and ultimately that the Fed is going to finally buckle and start cutting. And those are the signposts we're looking for to get long duration. But for now, we're pretty much neutral on top of the ag. I already mentioned in credit, we're playing defense, again, waiting for opportunities to buy cheaper bonds. And I really do believe sometime over the next year or so, we will have another bite at the apple there. So in a nutshell, what your investors can expect. So the aggregate index is yielding about 5.25. Like I said, we're trying to beat that, on a net basis by about 100 or so. So call it, in the kind of low to mid 6s in terms of an all-in yield or expected return on this portfolio, which I think is really attractive, right? And that's in a static environment. If rates fall 50 or 100 basis points over the next few years, which I actually believe is likely, I think they've overshot. I think fair value on the 10-year is probably closer to 3 3/4 or 4 than it is at 4.70. So if you get that moderation ultimately and more rate cuts got priced in, I mean, you can actually have returns in a strategy like this, in high quality, intermediate US fixed income, getting into the mid to high single digits, right? So there's actually, I think, a really strong case for adding more to fixed income, adding a little more duration in your portfolios to lock in this higher level of yields. And you're going to get really attractive returns. Even if yields don't move, you earn this really attractive yield. And if they come down a little bit or God forbid you have a recession and rates come down a lot, I mean, this can really act as a ballast in your portfolio. So I think that role of fixed income is back, right, as kind of a diversifier if you do get a slowdown in the economy.
Got it. But even without that, just to hit on your other point, right, you were saying if rates do stay at this level, it's how you utilize the plus sectors and the positioning where you can still add that extra alpha or excess return to give investors what they've seen, right, over the last 3-5 years, but to continue to generate that excess return going forward, which I think is great in that environment. So, well, Mike, I want to thank you for your time today. The fund does score a 10 on our system out of 10 Very attractive, 27 basis points to access this strategy. Again, it's our Core Plus CIT, so very attractive pricing and amid what's going on today in the markets. I think a great place to be, certainly if advisors and their plan sponsors are looking for alternatives with some of the other strategies that may not be faring as well, certainly as you guys have. So appreciate your time today and giving our advisors, some more points on the PGIM total return strategy. So thank you, Mike.
Thank you so much. Really a pleasure to join you today.
Great discussion, Jeff and Mike. It's always fascinating to hear about successful investment strategies. Finally, we have Lou Sideropoulos from Alliance Bernstein, who's going to share some fantastic educational resources that you can use to help tackle your retirement planning challenges.
Hello, my name is Lou Sideropoulos, and I lead the retirement sales team at Alliance Bernstein. First, let me start with a thank you. Thank you for your partnership, whether it's with our CITs. We currently offer our Large Cap Growth 3 and Small Cap Growth 2 CIT in your system, or any AB managed strategy that you are using. We appreciate your business, and it's something we don't take for granted. We also appreciate what you all have to deal with in our industry on a daily basis. It seems like when you finish dealing with one challenge, there's another one waiting for you, whether it's the capital markets, legislative changes, or the challenges in running your own practice. Now, over the past year, the two topics or conversations that have come up the most between advisors and AB, without question, has been around the markets and the challenges that some of you are facing in running or even growing your own practice. Now, what's great about our business is that there are some great resources from AB and other asset managers that can assist you in tackling some of those challenges. I'd like to spend the next minute or two making you aware of two resources that have become the leaders at Alliance Bernstein when it comes to being leveraged by financial professionals like yourselves. The first being around practice management. At AB, we have a group called the Advisor Institute, which is led by a gentleman, Ken Heyman. Ken, who was a practicing psychotherapist for over 20 years, has created a library of programs, videos, blogs, white papers that overlays behavioral science, marketing, and communication with the different challenges our industry faces. Ken's program takes a unique approach. He not only identifies the challenge in the objective, the proposed solution, but he makes sure the advisor understands why he or she is taking the approach that they're going to take. As a former psychotherapist, all of his programs takes into account how the human brain works and why certain behaviors take over in certain situations. And by understanding how the brain works and reacts, communicating your message in a certain way increases the probability of success. You may have heard us speak about our Advisor Institute in the past, but I wanted to share that we have added Ken's programs to podcasts. You can find them on our website. You can find them on Apple, on Spotify, simply by searching for Alliance Bernstein or Ken Heyman. And since rolling out many of Ken's programs on podcasts just a few months back, we have had close to 5,000 listens and downloads. His topics are diverse, they're relevant, and impactful. Today, the program that's getting the most attention is called the Effective Client Review, which again is available either in a white paper or a podcast. It's a quick listen. Now, the Advisor Institute is one of the resources available to you to hopefully address some of the challenges. The other resource that's utilized the most is around the capital markets. You'll find our economic perspectives ranging from the global economy to fiscal policy, as well as our views on various investment perspectives, like the US housing market, the impact that artificial intelligence is having on investing. Same format, available in white papers, videos, and podcasts. Now, last year, we started a quarterly series providing our perspectives on critical issues facing the capital markets. Think the US banking transition or US debt. The series is called the Disruptors Series. which falls under the capital markets umbrella and has been extremely popular with financial professionals given everything that's going on in the markets. Now, if any of these topics are of interest, you can find them all on abfunds.com, or you can look them up on Spotify or on Apple and download some of the podcasts. Or as always, you can call your AB representative for more information. Thank you again for your partnership and for your time.
Thank you, Lou, for sharing those incredible resources from Alliance Bernstein. And that wraps up our special anniversary edition of the RPAG Scoop. We hope you enjoyed this month's lineup as much as we did. And remember, all of these resources are available to you as part of your RPAG membership. And if you need any help reaching out to us or figuring out how to use these resources, don't hesitate to reach out to our support team at support@rpag.com, or you can call us at 949-305-3859. Thank you for being with us throughout this amazing year, and we look forward to many more scoops to come. Have a great June, and we'll see you next month on July 1st for the next exciting edition of the RPAG Scoop. Stay tuned and take care.